Hey everybody, how we doing? So on today's video, I want to go back to the fundamentals, back to the basics a little bit, and discuss wedges and triangles, which are two of the most popular formations in Bitcoin. And then we're going to go over how to enter, why entering is largely, where you enter is largely based on your risk preference and personal preference. And we're going to go over where to set stop losses, and we're going to cover whether you should be entering with market orders or limit orders. Okay, so we're going to cover every imaginable way I can think of to play these wedges. We also need to understand that when it comes to playing formations, sometimes you have to, not only is it personal preference, but you have to play the opportunity that's given. Okay, the two lines that I have here, first off, let me just turn off this price line so we get it out of our way. The two lines that I have here, and we're going to turn off the price as well. Okay, now we're all set. So the two lines I have here, red line is going to be our stop loss, and our green line is going to be our entry point. So the first thing we're looking at is a rising wedge, which is typically a bearish pattern. Okay. There's a few ways to enter upon a rising wedge here. So let's go over the first one. The first entry is from the top point of the wedge. So the price action is going to look like this. I'll show you an example for each one. The price action is looking like this. You get in on the top here, right when it's testing resistance, and then you put your stop loss a little bit above that point. Now, I'm not going to get into layering in this video. You could check out some of my other videos for layering, but it never hurts to layer, or if you want to. And when I mean layering for this situation, this would be a tight layering situation. Or you can simply just use one order on the resistance level, okay? Using stop loss above. The advantage of layering is, let's say you had, I'm just going to do this real quick, if you had one layer here, one layer here, one layer here, and one layer here, then you are able to move your stop loss higher and reduce the risk of a stop run because your average entry is going to be closer to the stop loss. Okay, like I said, check out the layering videos if you need more information on that. So this is the first type of entry here. You have your entry right here and your stop loss above the wedge. Okay, so the second type of entry, when you're near the top of the wedge here, and the price action is teetering along the side, and you think it's okay, it's about to dump here. So you're seeing the price action teeter along the side here, and so you jump in. Sorry about that, hold on. So you jump in right about here, and then you just put your stop loss above. The other way to do this is to wait for a break in the formation. So what you're going to do is you're going to start with pretty much like the 15-minute chart, and you're going to look at your trend line and you're going to say, okay, has there ever been a new 15-minute candle formation outside of the formation? If not, or has there ever been a new 15-minute candle close outside of the formation? If not, then upon the brand new 15-minute candle that forms outside of the formation, you enter, stop loss back inside of the wedge. Okay. Now, talking about the way the orders have to be. For the first situation where we were entering here, this is a limit order. You can fill a limit order here and you're okay. If you're teetering along the edge here, you could fill a limit order and you're okay. If you're playing essentially the breakout or the breakdown, you will need to use a market order to jump in on the brand new candle most of the time. Stop loss can be tight back inside the formation. Also, what you can do is, if you believe it could be a fake out, then what you want to do is you'll still want to utilize a wider stop even upon the break in the formation. So break in the formation, your stop loss is still above the rising wedge. Now here's where I talk about personal preference and risk factor. When you are setting up your stop loss and you're entering one of these positions, there's no wrong or right. This is the style of a conservative trader. They play the teeter position, or they play the breakdown, or they play this resistance line here, and they use a tight stop loss all around. Then you have someone who's willing to risk a bit more, a little bit riskier, but they're less likely to get stopped out if it comes back inside the formation for a minute. So pretend how many times have we seen this? Pretend the candle comes down and it drops out for a second and it pops back in, and then it does a little bit more and then it finally drops. The market maker loves to do that, okay? So for that situation, which, it happens sometimes, but it doesn't happen to the extent where I believe you need to build a strategy around it. But if you are the type of person who you feel like this is happening to you often, then you may be a type of person who wants to utilize a bit higher risk and a wider stop loss. Once again, the stop loss is a personal preference. There's no right or wrong. The person who's using the tighter stop loss is going to get stopped out more, but they're going to lose less money in the long run. The person who's using a wider stop loss will get stopped out less and will probably find more successful moves after fake outs, but they will, when they do get stopped out, they're going to be eating bigger losses. Okay, so that's how we play the rising wedge. I'm going to take a sip of water here. All right, so now we move on to the falling wedge. The methods to play this. And also, actually, let's just cover one more thing. You can also play the retest of the wedge. So let's say that the price action is coming upwards on the falling wedge, and this also doesn't happen often, but sometimes it does happen. Say the price is coming up and it drops out for a second, it bounces. Upon the retest right here, you can enter. So you can enter upon the retest. Once again, personal preference, stop loss wider or stop loss inside. I believe for this specific situation, though, a tighter stop loss is wise, because if it does come back all the way up to recover and it gets back inside the wedge, perhaps your wedge was not drawn correctly, perhaps there's some type of a channel going on, and perhaps the price may continue upwards, and utilizing a wider stop when your formation is not playing as you predicted is probably not the best idea. Okay, moving on to the falling wedge. There's a few ways to play this one. Once again, you can enter upon the support. So this support area right here is the same as this resistance area over here. So you could enter right here, stop loss below. The other option is to enter when you believe the breakout's going to be coming, tight stop loss or stop loss below this side of the formation. Those are both situations where you can use limit orders. And then there's the breakout play where you wait for, a confirmed candle close outside of the formation. And remember, the confirmed candle close means a candle that has not yet closed outside. So it may be a 15-minute, it may be a 30-minute, it may be a 1 hour, it may be a 4 hour. So if you look at the past formation and you say, okay, there's been 15-minute candle closes that have closed outside the formation, but there's never been a 4-hour candle that closed outside the formation, or there's never been a 1-hour candle that formed outside of the formation. Those are the ones you want to look for. There could be constantly 5-minute candles forming outside of the formation. That's not what you want. You want to only market order off of a candle close that has never formed outside of the formation. That's typically the first opportunity. So you have this situation with support limit order here, stop loss below, and or tight stop, however you want to set it up. And you also have the order where it starts to, you think it's about to break out. So you're like, oh, okay, I think it's about to break out. So you get a limit order here. And you set your stop loss. Once again, you can go tight stop loss or you can go a little bit wider, because if it does happen to attempt to break out and it comes back in for a second and then it breaks out, your wider stop will help you. But if it happens to fall through, your wider stop is going to hurt you with a bigger loss. So once again, stop loss proving to be very personal preference, very much about risk. How much do you want to risk? How confident are you in the specific play? So it's all about whether how tight of a stop you want to use, your personal preference. If you're using a tighter stop, more likely to get stopped out. If you're using a wider stop, less likely to get stopped out, but more likely to tally up some big losses over time, compared to where the tight stop, you're going to get stopped out more, but the losses are going to be much smaller. Okay, so you have the break of the formation play, where you enter upon the break, stop loss below or stop loss below. Okay, so that is how you are playing your rising wedge and your falling wedge. Now let's move on here to our triangles. Once again, rising wedge, typically a bearish pattern. Falling wedge, typically a bullish pattern. What we're expecting out of these is something like this. We're expecting a drop, and here we're expecting a pop. Okay? Now moving forward to the triangles here. Triangles are known, especially in Bitcoin, to pretty much go either way. So let's cover how we enter on triangles and what the opportunities are. So, and remember that speaking of opportunity as well, sometimes you don't always get the opportunity to play the formation exactly how you want to. You have to be ready for what comes. So let's say the rising wedge is forming and you're waiting for this entry, but it never happens. So you need to be ready for either basically the teetering entry, as I called it, or the breakout entry. Okay, sometimes you don't always get a chance to get that entry you want, so you have to adapt to the situation as well with these formations. Once again, with the falling wedge, it may get bullish around here, and you may think, oh, well, I don't have my chance to get in here. So in that situation, you would enter here and probably utilize tight stop, just in case it does happen to come down. Then you can get your better entry here, depending on how much of a price difference there is. If there's a 400 or 500 point price difference between here and here, I'd rather utilize a tight stop, of say 50 to 100 points, and then be able to get in down here with a difference of, say 350 to 400 points. So it definitely matters how much the price difference is within the formations. Okay, so talking about the descending triangle here. Oh, I deleted my lines. Okay, we got our stop loss line here, and we got our buy line here. Okay, so let's pretend that, and these can go either way, so I'm just going to play them. I'm going to use the descending as a breakdown, and I'm going to use the ascending as a breakout. Typically, that's how they play more often in Bitcoin, but it's really not fair to say it. They play either way, okay? So let's do the breakdown here on this formation. So the price action in here looks like this. We come in, we're forming, boom, there's our first chance to get in. So same idea as these wedges. There's our first entry point, stop loss above, okay? And stop loss on these, I believe, is fairly easy to set up. It just matters how much risk you want to use. If you want to use more risk, but you got to be careful, because if this does break out, then this stop loss is probably going to get hit either way. Something that's wise to do with these formations is to have on BitMEX a stop loss set out on both sides, and be prepared to enter the formation whichever way it breaks. So you have a stop loss below and you have a stop loss above, and then you're going to enter either upon the breakout or you're going to enter upon the dump. And a question I'll always get is, oh, well, aren't we going to get stopped out one way or another? No, because this order will be a buy stop and this order will be a sell stop. So if you're, wait, did I say that right? Let's see, if you short out of this formation, then this line here will be this will be a sell stop. Okay, so you're shorting here, this is a sell stop, and that means that unless your close on trigger, make sure close on trigger is checked on BitMEX, and if this drops, the stop loss will not affect your order whatsoever, this one. So basically, just make sure close on triggers on, and then set these stops up, and I promise you, you will see that the only way one of these stops activates is if the order goes against you. If it goes into profit, the stop loss will simply cancel itself and you'll be perfectly fine. So this is basically like a high intensity play here, where you can play the breakout. It's a market order or it's a market order, okay? And getting back to the other situation, if you have other signs of, say, bearish confluence, or something of that nature, then you can enter at the top here, stop loss above. If you believe it's bullish, you can enter at the bottom, stop loss below, or you can do the double stop loss strategy, or you can simply enter upon the break and utilize stop loss as you would with, like you did right here. Enter upon the break, stop loss above, or stop loss above even further if you are worried about it coming back into the formation after it breaks, pops back in, and then it goes down. Okay, once again, a matter of personal preference where you put the stop. Now we will do the ascending triangle here. Water again. So with the ascending triangle, let's take a look at how it might be playing. It gets into here. Let's say that you think, okay, this is bullish. I think this is going to break out. How do we play it? Well, you can enter from the bottom here, where it hits support with a limit order, stop loss below, depending on how wide you want to go, and you can enter as it gets to the teetering point up here, either stop loss below or stop loss below if you're afraid of it coming back inside, or you can play the breakout, hop in on the breakout of a new candle formation, stop loss below or stop loss below. From a psychological perspective, what this situation right here is what you should be saying. You should be playing this if your mind is saying, okay, I think this is going to break out, and once it breaks out, it's going to fly. That's the situation to use this stop loss. And then if your stop loss is down here, once again, you're risking much more, but you're thinking, this might break out, this might not break out, it might come back in the formation, but overall I feel bullish about a breakout here. That's when you utilize this stop loss. Okay, so these are all the formations here, pretty popular formations that we've been seeing recently, and a overall summary on how to play them, your entries, your stops, whether they're limit orders or market orders. The difference is market orders are more expensive, so you always want to use limit orders when possible. Market orders are going to cost you more in fees. Overall, entering formations is very much about personal preference and your personal risk factor and the opportunity that the formation is allowing you. So if it's not allowing you to get in at the resistance level or the support level, then you may have to play when you think it's about to break, or you may have to play the breakdown. And that goes for all the formations. So it's very much personal preference. I don't really believe there's one right way to do it. It varies per situation, per your confidence level in the formation, and per basically if you think, oh, this is about to break down any second, then maybe you have to use a market order to get in. But once again, basically all just personal preference. There is no right way. There's many ways to play these. We just outlined them all. I hope that helps. Thank you very much. Have a great day, everybody.